Welcome back to the Deep Dive. So it's early 2026, and if you've been watching the software sector, you know the vibe right now. It is tense.
Oh, absolutely. There's a pretty significant sell-off happening, and it's all driven by one big narrative.
AI, the fear that artificial intelligence, automation is coming for everyone's lunch.
Especially in places like legal, sales, accounting. The question is, why pay for software when an AI agent can do it for pennies? It's creating a lot of volatility.
Exactly. And right in the middle of all this panic, SS&C Technologies drops their Q4 2025 earnings report.
And SS&C, for anyone who doesn't know, might just sound like, well, back-end plumbing for the financial world.
Which is kind of underselling it, right? We're talking about the engine room for something like $3.5 trillion in assets.
Calling them plumbing is technically accurate, but it really misses the scale. They're the infrastructure.
Yeah.
If the financial system is a gold rush, they aren't just selling shovels.
They're selling the conveyor belts and the vaults.
Exactly.
So that's our mission for this deep dive. We're going to wade into those Q4 earnings. They just came out February 5th to answer this massive question. Is a legacy giant like SS&C a dinosaur about to go extinct?
Or are they actually the ones building the Jurassic Park? I love that. And to figure it out, we've gone through the earnings call transcript, the press release, and their whole financial slide deck.
Okay, so let's start with the money. Because despite all the doom and gloom out there, SS&C just posted what they're calling a record-breaking quarter.
The numbers are undeniably strong, especially given the macro environment.
Let's hit the headlines first.
All right.
Adjusted revenue for Q4, $1.655 billion. That's up 8.1% year over year.
And the bottom line is even better.
Right. Adjusted earnings per share EPS came in at $1.69. That is up a staggering 18%.
And those are the headlines, and they're impressive. But, if we really want to understand the health of the business, we have to look at the quality of that money.
What do you mean by quality?
I mean, in software, revenue can sometimes be vanity. Cash is sanity. And SS&C is proving to be an absolute cash machine.
You're talking about their operating cash flow.
Exactly. For the full year 2025, their operating cash flow was $1.745 billion. That is up 26%. But the metric that really jumped out at me was their cash conversion.
Okay, pause there. For anyone listening who might hear cash conversion and just, their eyes glaze over, break that down. Why does that matter so much?
Sure. So companies report net income, right? Which is this calculated profit based on accounting rules. But you can't pay your bills with net income. You pay bills with cash.
Ah, okay.
Cash conversion just measures how much of that on-paper profit actually hits the bank account as real spendable cash.
So you could be profitable but technically broke if clients don't pay you.
Precisely. Or if you have to spend a ton on new equipment. But SS&C has been converting their earnings into cash at a rate of over 100% for the last 3 years.
Wait, over 100%? How's that even possible?
It sounds like magic, but it just means their cash flow is higher than their reported net income. It's a sign of extreme efficiency. They are just fantastic at collecting their bills and managing expenses. It tells you the earnings quality is incredibly high.
And what I found really interesting is what they're doing with all that cash. Because you'd think in this market, early 2026, they just hoard it.
Prepare for a rainy day, yeah.
But they're not. They're spending it on themselves.
It is a massive vote of confidence. In 2025 alone, they bought back over $1 billion of their own stock.
$1 billion. That is not pocket change.
It tells you two things. One, management thinks their stock is cheap. And two, they can't find any good companies to buy at a reasonable price. So they're saying the best investment right now is us.
Bill Stone, the CEO, basically said that on the call. He said they'll prioritize buybacks unless a really good acquisition comes along.
Which is such a disciplined stance. Everyone else is tripping over themselves to overpay for the next shiny AI startup.
Right.
And SS&C is just standing pat and buying their own stock. It's a flex.
Well, speaking of shiny AI objects, let's pivot to the elephant in the room. The AI question.
Ah, yes. This is where the transcript gets really spicy. It's the core of the bear case against them.
Right. The argument goes, why am I going to pay SS&C to do my fund administration when some AI agent can do it faster and cheaper?
It's a totally valid fear for the industry. I mean, if your only value is doing math and data entry, you are in big trouble.
But Bill Stone's rebuttal on the call was, let's just call it colorful.
He did not mince words, no. He kept bringing up hallucinations.
Which, just to define that, is when an AI just confidently make stuff up, right?
Exactly. It presents false information as fact. And Stone's point was that when you're dealing with the SEC or Medicare, you can't just go, oops, sorry, the AI had a bad dream.
He literally said regulators don't accept it was a bad dream as an excuse.
And that's the whole defense. It leads directly to their moat.
The moat, a term we hear all the time. But here, it's not really about tech, is it?
No, it's different. The bear case assumes SS&C's value is just code, but their real value is the liability shield. They have 23,000 clients, 29,000 employees. They manage data for trillions of dollars.
So as a hedge fund manager, I'm not paying them to do the math. I'm paying them to be responsible for the math.
That's it, exactly. Some startup can build an app with a little AI spice, as Stone put it. They can't replicate the trust, the compliance, the infrastructure overnight.
So the red tape is actually the asset.
In a way, yes. If you're a massive hedge fund, are you going to risk your entire license on a startup's AI agent? Or do you want a partner who can take the blame and the financial hit if something goes wrong?
That's a powerful distinction. It's not about being able to do the work. It's about being able to survive the audit.
And it's important to say they aren't ignoring AI. They're embedding it. They call it intelligent automation.
Right, through Blue Prism, their automation company.
Correct. They're using it to automate their own internal work, to improve their own margins. They're aiming for accuracy and auditability, which are the two things AI really struggles with right now.
So while the market's freaking out about AI replacing accountants, SS&C is basically positioning itself as the safety layer on top of the AI.
That is a perfect way to put it. They want to be the ones who make sure the AI doesn't get you arrested.
Okay, let's move on to the actual business segments, because it wasn't all good news. There was a real split in performance.
A tale of two segments, for sure. The divergence is pretty stark. One engine is firing on all cylinders, and the other one's sputtering.
So on the positive side, we have the star performer, GIDs, Global Investor and Distribution Solutions.
I know, catchy name, but the numbers are serious. Organic growth of 13.2% in Q4. That is just massive for a business this mature.
What's driving that? What is GIDs actually doing?
Think of it as the plumbing for long-term money. Retirement funds, pension funds. It's incredibly sticky business. A huge retirement fund isn't going to switch platforms because they saw a cool ad. It's too risky.
They also mentioned lift-outs as a big driver. Can you explain that?
A lift-out is like extreme outsourcing. A big investment firm comes to SS&C and says, look, we don't want to run this back office department anymore. It's expensive, and it's not our core business.
So SS&C just takes it over.
They literally lift the whole department, the people, the tech out of the client and drop it into their own operation. They mentioned doing this with Insignia and Humana. These are huge multi-year deals.
And then SS&C uses their automation tools to make that department more efficient.
That's the playbook. They take on the cost, optimize it, and turn it into a high-margin business for themselves.
Okay, so GIDS is the golden child. But now we have to talk about the problem child this quarter, healthcare.
Oof. Yeah, healthcare was difficult, down 14% organically in Q4.
That is a steep drop. And Q4 is usually their strongest quarter for healthcare, right?
Yeah. It is, historically. So this was a significant miss.
What?
It comes down to the business model for that segment. Unlike GIDs, which is steady and recurring, healthcare relies on these huge one-time license deals. It makes the revenue lumpy.
If you close the deal on December 31st, you're a hero. If it's January 2nd, you miss the quarter.
And that is literally what seems to have happened. Bill Stone mentioned a notable multi-million-dollar license that slipped and closed in the first 10 days of January.
Ouch. But there was also that specific client story that really stood out. The Elevance saga.
Oh, yeah. That's a classic cautionary tale for anyone in B2B sales.
So Elevance is a huge client, but Stone was really candid. He said their original sponsor, the person who championed the project at Elevance, left the company years ago.
And that's the nightmare scenario. Your champion leaves and suddenly no one returns your calls. Stone said, when you lose a sponsor, it's hard to find another one.
The new person wants to do their own project, not inherit someone else's.
It's just office politics. It shows that even at this scale, you're still dealing with very human problems.
Is there any silver lining for healthcare?
There is. The margins are still high. They're managing the business for cash flow, not just growth at any cost. It's a profitable segment, even if it's not growing right now.
So they're just letting it run efficiently.
Precisely. For now, GIDS and the core fund admin business are carrying the team.
Speaking of carrying the team, let's look ahead to 2026. They gave guidance, and there's one number that keeps popping up. 40. The rule of 40.
This is a really key benchmark for software investors.
Explain it for anyone who's not a finance nerd like us.
So the rule of 40 is a quick way to measure the health of a software company. Usually, it means your revenue growth rate plus your profit margin should equal 40.
But that's not what SS&C is doing, is it?
No, they're blowing it out of the water.
Yeah.
They are aiming for a 40% EBITDA margin alone.
Just the profit margin, before you even add growth.
Yes, they hit 39.3% in Q4. They're guiding to hit that 40% mark by the end of 2026. I mean, that is an elite level of profitability.
How are they doing that?
It's all about efficiency at scale. They own their own private cloud, so they're not paying huge fees to Amazon or Microsoft, and they're automating everything they can.
So what's the revenue projection for 2026?
Between $6.65 and $6.74 billion, which puts organic growth at around 5.1%.
5.1%. So it's not explosive, but it's steady.
And that's the key. One of the executives said the business is becoming more predictable, less reliant on those huge, lumpy deals.
In a volatile market, stability is pretty sexy.
It certainly is. Investors hate surprises. SS&C is signaling we are a steady ship.
Before we wrap, we have to touch on M&A. Did they mention any new acquisitions?
They're looking, but they're disciplined. They said the Calastone deal they did is performing really well, which shows they can still integrate new companies successfully. That's their superpower.
And they have the money to do more if they find the right deal.
Absolutely. Their leverage is very manageable. But like we said, they seem perfectly happy just buying back their own stock if prices for other companies are too high.
Okay, so let's bring this all together. We started with the question, is SS&C a dinosaur? Or are they a park builder?
I think the evidence points to a very, very well-armored park builder.
They're generating record cash. They're protecting their business with a regulatory moat that AI can't just leap over.
And they're using the very technology that people feared to make themselves more profitable. For the learner listening, the lesson here is all about structural protection. Technology changes fast, but the rules around managing trillions of dollars, they move much, much slower.
Boring and reliable beats fast and hallucinatory.
Especially when that much money is at stake. You want move deliberately, improve everything, not move fast and break things.
That is a great takeaway. But here's a final thought to leave you with. Bill Stone made that comment about how it's easy to start a fintech with a little AI spice.
Right.
And it makes you wonder, as AI makes the act of writing code basically free, as it commoditizes software itself, does the entire value of a company shift?
Go on.
Well, if anyone can build the app, then maybe the app isn't the real product anymore. Maybe the real product is the 29,000 people who make sure the app is legal and auditable. Maybe in 2026, red tape isn't a hurdle.
Maybe it's the most valuable asset a company can own. That's a fascinating inversion. If code is cheap, compliance becomes gold.
Something to mull over.
Yeah.
Thanks for listening to this deep dive. We'll see you next time.